Hi guys, welcome back to TipRanks. My name is Annika and here at TipRanks we love to hear what you guys think of different stocks you're looking at and your opinions on the market sentiment. Now recently we've covered a lot of tech stocks and dividend stocks, but what about some of our favorite stocks out there? Stocks that we all use potentially day to day, I know I do, and that is media stocks. So in this video, we're going to look at Netflix and Disney. I know I love using both myself, but let's see which stock can give us a hit this year. So let's take a look at Netflix first, and its ticker is NFLX. As you know, Netflix is an entire content library of movies and TV shows, and it has a subscription as a service model, like Disney does as well. Taking a look at the current price of Netflix, it's $510.90. The analyst rating consensus is a moderate buy, and the analyst price target is $658.97, which is a 28.98% upside. Now, website traffic is quite an important tool to gauge the performance of media companies such as Netflix and Disney, and this is because a lot of us are able to watch their content via their streaming websites. So looking at the Netflix website traffic chart on TipRanks, we can see that this year has been fairly steady. However, it has been trending downwards. This could be because of increasingly more and more people are going outside due to the easing of restrictions and life returning fairly back to normal. It seems like their stock price has followed a similar trajectory. However, this downswing could be reversed based on the following factors. Now, before we look at the bullish news on Netflix, let's look at where we're at. Netflix is one of the world's leading entertainment services, and it has 214 million paid memberships in over 190 countries that enjoy TV series, documentaries, feature films, mobile games across a variety of genres and languages. Netflix is actually expected to announce its fiscal fourth quarter results this week on January 20th. But let's just take a look at their Q3 results. Revenue growth in Q3 was driven by 9% and 7% increase in average paid streaming memberships and ARM respectively. This actually exceeded their beginning of quarter forecast due to the timing of their content spend as well as lower than forecasted marketing spend. Their EPS, so their earnings per share, were $3.19 versus only $1.74 a year ago. But analysts and investors are quite skeptical about whether Netflix can sustain its pace of subscriber net additions as it has increasing competition as well. The company's rise in paid memberships globally is actually slowing down. Netflix's main competitors are YouTube, Hulu, Prime Video, and Disney+. In the third quarter, the company had global paid memberships of $213.6 million, which was a growth of 9.4% year over year. The rise in paid memberships is expected to slow down in Q4 to 9%, with paid net additions of 8.5 million. Even the rate of revenue growth for Netflix has slowed down to a year-over-year growth rate of 16.3% in Q3 versus a year-over-year growth rate of 22.7% in Q3 of 2020. Just as a reminder, we expect the Q4 2021 financial results to be released on Thursday, January 20th, 2020 at approximately 1 p.m. Pacific time. The company has been expanding their content library with new content, and it's also raising prices in certain territories such as the US and Canada, so mainly in North America. A spokesperson for Netflix said that we're updating our prices so that we can continue to offer a wide variety of quality entertainment options. As always, we offer a range of plans so members can pick a price that works for their budget. The company explains on their website that when we exchange plans or prices, we're always working to improve the Netflix experience and invest in the quality content for our subscribers around the world. Which is why last week Netflix raised its prices for membership plans in the US and Canada. The company raised the price of its basic plan by $1 to $9.99 per month, while the standard plan increased from $13.99 to $15.49, and the premium plan jumped from $17.99 to $19.99 per month. The TipRanks Smart Score deems it to be a 9 in that it is expected to outperform the market. The analyst ratings deem it to be a moderate buy, and TipRanks investors are also very positive. Blogger opinions are bullish and news sentiment is also bullish. Technicals have also been positive. As we know, Netflix is expected to announce its fiscal fourth quarter results on January 20th. Just before its earnings, the stock slid 2.5% in the past 5 days and by around 10.4% downwards this month. But analyst Scott Devitt from Stifel Nicolaus deems it to be a buy with a $660 price target, which is a 29.24% upside. He actually lowered his price target from $690 to $660. This is because some of Devitt's concerns include the possibility of subscriber growth slowdown, which he said was potentially weakening app engagement beginning in November, and lower profits in international markets as predicted by the recent price reduction in the Indian market. Scott Devitt also cited app engagement data from Apptopia that suggested that Netflix's subscriber additions in Q4 could be modest. This is because Netflix clocked monthly active users as of December 31st of around 217.6 million, and this was a drop of 2.2 million from Netflix's expectations of 8.5 million net additions in Q4. And this trend was also confirmed on the TipRanks website traffic tool, which indicates that growth in monthly unique visitors across all devices has fallen year over year by 0.6%. to around 300.1 million, while there is a slight increase of 0.1% year-over-year growth in Q4 Netflix traffic to 889.1 million unique viewers. On this chart, the green line is the website traffic and the gray line is the year-over-year traffic. As mentioned, the second stock we're looking at is the Walt Disney Company, and its ticker is DIS. The Walt Disney Company is an American multinational media and entertainment conglomerate. They also own Disney Plus, which is their subscription video on demand streaming service. The current price for the DIS stock is $152.26. The analyst rating consensus deems it to be a moderate buy. The analyst price target on DIS is $195.35, which is a 28.29% upside based on 22 Wall Street analysts offering 12-month price targets. Looking at the Walt Disney website traffic chart, you can see that there has been an increase in unique viewers across 2020, and then it stabilized in 2021. We are expected it to decrease in 2022. Disney's stock price has actually fallen by 11.4% in the past year. Investors have actually been concerned about whether the company will be able to achieve subscription numbers of between 230 million and 260 million by 2024 year end, especially for Disney's direct-to-consumer services. Disney is expected to release its Q1 2022 earnings on February 9th on Wednesday at 1:30 Pacific time. In bullish news, Disney is expected to increase content spending to around $33 billion in 2022. The company's spend across originals, licensed content, and sports rights for the fiscal year of 2022, which began on 1st of October 2021, will increase from its most recent annual spend of $25 billion. The report that Disney released did not break down on exactly how they will spend $33 billion, but it is revealed that Disney estimates that it will produce around 60 unscripted series, 30 comedy series, and 25 drama shows. There are also 15 docuseries in the works. In their Q4 2021 results, they actually showed an earnings per share from continuing operations for the quarter with an income of 9 cents compared to the loss they had of 39 cents in the prior year quarter. Their CEO, Bob Chapek, said that this has been a very productive year for the Walt Disney Company, as we've made great strides in reopening our businesses whilst taking meaningful and innovative steps in the direct-to-consumer and at our parks, particularly with our popular new Disney Genie and Magic Key offerings. He also said that as we celebrate the 2-year anniversary of Disney Plus, we're extremely pleased with the success of our streaming business, with 179 million total subscriptions across our DTC portfolio at the end of the fiscal year of 2021, and there was a 60% subscriber growth year over year for Disney Plus. Their revenues were $18.5 billion in October 2nd of 2021 compared to $14.7 billion in that same quarter of October 3rd of 2020, which represents a 26% increase. The TipRanks Smart Score deems it to be an 8 in that it is likely to outperform the market. Analyst ratings deem it to be a moderate buy, and TipRanks investors are very positive. Blogger opinions are bullish, and hedge fund activity has increased, despite technicals being negative. JP Morgan analyst Alexia Quadrini is bullish on Disney stock and gives it a $220 price target, which is a 44.38% upside. Her reasons for being bullish is because of Disney's direct-to-consumer services being launched in the latter half of this year. Her reasons for being bullish are because of Disney's direct-to-consumer services being launched in the latter half of this year, including in Eastern Europe and Middle East and in South Africa. Quadrini also added that the content releases will likely reach a steady state in Q4 of 2022, with one flagship title per week, along with more local language content. The analyst also believes that investors should ignore the lower-than-expected first half of 2022 Disney Plus subscriber additions and near-term noise at the legacy businesses due to COVID-19, as we expect a re-acceleration of subscriber growth into the second half of 2022 and in 2023, as well as the broader recovery of the legacy business with parks ramping back to pre-COVID margin levels in the fiscal year of 2023. Disney is one of Quadrini's top stock picks in the media sector, as the analyst thinks that the company has the best intellectual property in the industry and has not only benefited until now from the flywheel of consumer interactions from DTC parks and theatrical releases, which should propel the stock higher in the long term. So guys, what do you think of media stocks, Disney and Netflix? Leave your thoughts in the comments below. Which one are you most bullish on? Or are you bullish on both? And if you made it this far, don't forget to hit that like button and that subscribe button and that bell notification so that you get informed on when the TipRanks channel releases a video. Remember, this is not financial advice. Make sure you do your own research before you invest in anything. I'll see you guys in the next video. Bye!